Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Wednesday. It's July 13th, and we're going to be opening up in about 90 minutes. It's 8 o'clock, 8:01, so an hour and 29 minutes to be exact. The futures are up. The Dow's up 84 points. The Nasdaq is up 33 or 44, depending on which month you look at. And the S&P is, in fact, meeting us halfway in between. Now, before I get ahead of myself, today in this video, I'm going to give you a long trade and a short trade. And these linked type of trades, it's not a perfect link trade, but it's very similar to what Jeff Zananeri is doing. And he's having a webinar tomorrow on Thursday. I believe it's happening at 1 p.m. So if you guys like these link trades, the idea of having a hedge and all that stuff, check out the link below and check out his video. You're going to love it. Now let's get into my analysis, and we'll talk more about the actionable long trade and short trade, and I'll explain why you should initiate it today and why it may work out really well, irrespective of what happens with the Fed. So just so you guys know, the biggest factor we want to pay attention to is the bond market. Now, here are the clues before I give you the numbers or go over the numbers. And this is a real big report, not because it's going to tell us things are bad. We know things are bad. It's going to give us clues of whether or not inflation has peaked out already or is still ramping up. And it's going to give us signs on core inflation. So the biggest way to interpret this number is this. If after the report, the bond market, and the bond market's up about 0.39 right now, so it's up less than half a basis point. But if you see a rally in the bond market, if you see a strong rally in the bond market, that means that the economy is in worse shape than we thought. Yes. Why? Because if the bond market goes higher, that means there's less chance of Fed increasing rates. And the only reason they would do that is if we're closer to a recession than we expected, and we need to back away. So if we're in recession land, they'll back away. But if the numbers aren't bad, if the numbers are looking better, if the numbers look like we may be, when I say better, I mean actually worse. If the numbers look like economy's getting worse and we're getting further in depth and we have not peaked out yet, then the bond market may come down. So the bond market is interpreting right now how close we are to a recession or how far we are away from the recession. And that's what this report tells us. So in all honesty, if the bond market goes down, that means the economy is actually doing better than we thought. If the bond market goes up, that means the economy is doing worse than we thought. The two numbers you want to pay attention to are the CPI. We're looking to see if it's going to be 8.8. It looks like 8.6 was the top. So if we go above 8.6, it means things are in fact getting worse. But if X food and energy were at 5.8, that means we might have peaked out. What would be really great would be to see this number, CPI, at 8.6 or maybe 8.5, and this at 5.8. It means there's a good chance we peaked out, and it means the Fed can kind of wait and see where things stand. And it also means we're moving a little bit further away from a recession. The bottom line is it's a balancing act. It's all a balancing act. The best case scenario would be for the bond market not to really move much and stay within this range, which would show that the market is basically assimilating and pricing in everything that's known and we're at fair value. Because if the bond market turns higher, it would be actually beneficial for the stocks. If the market turns lower, the bond market turns lower, it's more pressure on stocks. So keep your eye on the bond market and how it'll interpret this. And also keep in mind, it's not an exact science. We can have the core CPI, which is what the Fed looks at 6. We can have the year-to-year at 8.6. The market could already be assimilating it. That's why the numbers are not as important as what the bond market does. What the bond market does is very, very important. So if this goes higher, you may see a rally in tech and chip stocks. If this goes lower, you'll see a rally in energy and consumer staple stocks. So it's one of those situations where if the news is worse than expected, that means the Fed is less likely to take further action, and that would be good news for tech stocks. If the news is getting worse, and it looks like we may be going deeper into this, That may be beneficial for energy stocks because that would say we're not in a recessionary pressure. We're not in a recession yet. So again, it's a real balancing act. It's a real balancing act. And obviously nobody knows what will happen, but the report is coming out in less than 26 minutes, about 25 minutes. Keep your eye on that report. And also, if the bond market goes up, you may see the NASDAQ rally a little bit. And if the bond market goes down, you may see the Dow rally a little bit. It's going to be one of those things. The other biggest factor you want to pay attention to is the volatility index and what it does, especially around these parts. Let me show you something interesting. And this is another thing you want to pay attention to. The last time we had the CPI report, this is what the Dow did. It went down all the way. If potentially we have another terrible report and the Dow goes down, what you need to pay attention to is volatility and whether this volatility starts breaking above previous highs. The last time the Dow made a new low, you see that right here, it happened 617. Look at volatility. Volatility did not make a higher high. It actually went down. So it looks like volatility and the bond market are pricing in the gyrations and are calling a bottom. But again, Powell and his cronies only know when that'll happen because there really are, I don't want to say the word manipulating. They're not manipulating, but they're controlling the destiny of our of the long bond right now. So it'll be very interesting if we start hammering up or clamping down. It'll be very, very interesting. Now, aside from that, here are a few things you need to pay attention to. The levels on the QQQ. It'll be very interesting to see if price starts moving higher or down on the NASDAQ. Keep your eye on this channel. And as long as we're within this channel, the channel of 313 versus 270, we're okay. But if we start breaking below this channel, we may have a little problem here, especially with chip stocks and tech stocks. And that level is at 271, all right? On the Dow Jones, the key levels to watch, and these are very, very important levels to watch. It's the 30,000 level. If we break the 30,000 level, we can be in deep, deep doo-doo, right around the 30,000 level. To the upside, it's like the 32,000, 31,800 level. If we stay within that range, we should be okay. But 30,000 is the bottom. On the SPY, those levels are basically 394 and 360. 394 and 360. And if we stay choppy within that level, and if we don't break the 360 level, we should be okay. Now, as far as sectors, I want to show you some sectors. As far as the major sectors are concerned, energy is still leading on a cumulative basis, but I wouldn't trust it. Keep your eye today on energy, consumer staples, and communication and consumer discretionary. One of these is going to give us a huge, huge sign. Now, if we have an increased chance of a recession, there may be a chance that they will both go down. But keep your eye on the sectors. The biggest factor in terms of sectors is I want to see if consumer staples, if we rally, if we can get above the 75 level on the consumer staples. Very, very important. On healthcare, we're almost there. On healthcare, it's the 133 level. And if we can get past the 133 level, there's a good chance the next level is 141. Most of these other sectors, like the financial, they look like they're just consolidating. They don't look like they're really up to anything right now. So if we just continue this channel, this will give me further signs that the market is in fact bottoming out, and these channels are creating a sideways trading action, just like you see here, 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 like you see here, like you see here, and like you see here. The market is becoming choppy. What's also important, and this is really important, is whether energies break the low or embrace this price level and go higher, because we're right at the 200-day line. So to summarize, let me give you a summary. Volatility. You want to see volatility makes a new high. You want to see bond market, which way it goes, up or down today, pending the report. The two most important levels is the core and year over year, the 5.8 and year over year, whether it's going to be 8.6 or whether it's going to be higher, and the core. Because if this one goes up a lot but the core stays, that means we know that the food and energy is causing most of the inflationary pressure. So be very, very careful and don't overreact on this report. The two sectors you want to watch carefully today are the energy sector, and see whether it breaks the 200-day line or rallies, and the discretionary sector, and you want to see whether it remains in the channel or breaks below this channel. And the bottom to this channel is 134 right now on consumer discretionary. I know I'm giving you a lot of information. Now, top stocks and worst stock. Top stock right now, I would stay with healthcare. Why? Well, you've got two choices. You've got consumer staples and healthcare. Those are the leading sectors. And as I mentioned, healthcare is already looking good, and some of these stocks are already above the previous swing high. Here's the healthcare sector. You could get a closer look at it. See how we're a little bit below the 200-day line? But look at Merck. We're already above the 200-day line. And healthcare is the sector that's least impacted by the by the CPI, because consumer price index and healthcare is just not a big thing. Also, notice how far we are above the 50 and the 200-day. I like Merck right now. I like the stock, and I like the ascending triangle. And there's a good chance, if the numbers are not too bad, we'll break higher above this level. To the downside, you've got NTAP. Now, this is just to show you what the stock does, it's an infotech stock, computer storage devices. And this stock has not been doing really, really well. And I don't think, even if the number is positive, even if the number is not too bad, I don't think it's going to be very bullish for tech stocks, especially these stocks that have been moving down. And I see a descending triangle here. So there's a good chance that this stock is going to break down. So to the upside, I like Merck, and to the downside, I like NTAP. And I think that's probably the safest way to trade this right now. Now, again, it's coming out, the report's coming out in less than 17 minutes. And I'll give you an update after the report on Telegram to kind of tell you what's going on. But again, these are the CPIs coming out, the big numbers, 8.8 and 8.6. Keep your eye, 8.6 to 8.8, 5.6 to 5.8, or 6 to 5.8 on the core. And if both of these numbers are down, that can give us a substantial rally. So again, before I let you go, I've got something important for you. And also, by the way, I would wait for the first hour of the day before initiating this Merck trade, or NTAP. Let the market show its hand. Let it kind of digest the news in the first hour. And if you like these long trade, short trades, you're going to love Jeff's class. Again, just a reminder, make sure you attend Jeff Zananeri's training Thursday, tomorrow, 1 p.m. Eastern Time. He's going to show you how hedge funds think, trade, and play macroeconomic events. Very, very important. As I've been saying for a while now, the next few weeks could be a make it or break it for the markets. Yes, a make it or break it for the markets. And you'll want to hear Jeff's market outlook and how he plans to navigate a Federal Reserve policy that could send shockwaves through the economy. Make sure you follow the link below and reserve your spot for Thursday's 1 p.m. class. And Jeff's strategy, what's really cool is he sometimes trades pairs, which means one long and one short, kind of like the Merck and NTAP trade I'm showing you. And that gives you a built-in hedge in the current volatility, which is really, really cool, because right now markets are crazy volatile and we need the volatility to cool off. But while volatility is there, these pair trades can save your butt. So again, CPI coming out. Don't miss Jeff's event, 1 p.m. Eastern Time, tomorrow, Thursday, 1 o'clock. If you don't know where the link is, go to the Wealth Press YouTube channel and you'll find it there. I'll talk to you guys later. Have a great day. Comments, feedback. Put some comments below this video. I want to hear from you. I want to know if I've been helping you guys survive this crazy time. Bye, guys. Have a great day, and I'll talk to you after that CPI report comes out.